Live from Sydney, I'm Paul Allen. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, a global sell-off in stocks and treasuries deepens. Oil fluctuates as the war in Iran enters a fourth week with no sign of de-escalation. Inflation fears now boosting bets on a Fed rate hike this year. President Trump issues an ultimatum to Iran to reopen the Strait of Hormuz by tomorrow, while Tehran threatens to close it completely and target more US and Israeli assets. We look at the conflict's impact on investor sentiment and wealth flows in the Middle East in an exclusive with the CEO of private banking group EFG International.
The war in Iran and soaring energy prices no doubt are also top of mind here at the China Development Forum in Beijing. We'll hear more from top executives gathered here, including UBS Group CEO Sergio Ermotti and Fortescue Metals Group CEO Dino Otranto.
And I'm Min Lo at the Milken Global Investors Symposium in Hong Kong, where later this hour we will speak exclusively with the CIO of the Indonesian Investment Authority about where they are deploying capital as geopolitical tensions rise.
Our top story today, the global sell-off in stocks and treasuries is deepening as investors pare risk. The war in Iran entering a fourth week and is showing no sign of de-escalation, with the US and Iran trading threats. President Trump has given Iran 48 hours to reopen the Strait of Hormuz or face the bombing of its power plants. Iran has countered that it would close the strait completely if it is attacked in such a way. Bloomberg Horizon's Middle East and Africa co-anchor Ramana joins us now from Dubai. So, Ramana, we're into week 4 and the rhetoric showing no signs of de-escalation, quite the opposite, in fact.
In the early hours of Saturday morning or late Friday evening in the U.S., President Trump insinuated that perhaps the U.S. may be considering winding down operations, but the tone decisively shifted by the end of the day, with him ultimately giving Iran a 48-hour window to reopen the strait, or else. And he said, or else the United States of America will hit and obliterate their various power plants, starting with the biggest one first. So that was a post that came out on Truth Social at around 7:45 p.m. Saturday evening Eastern time, which takes us to basically this evening, if that ultimatum were to be met. But in response, we've had the Iranians once again come back with very strong words. They've said that they will completely shut down the strait if President Trump follows through, and that regional energy and water infrastructure would be targets if the U.S. decides to go after their power plants, and that they will not hold back this time. And they've gone one step further with the Speaker of the Parliament overnight also suggesting that any entity that buys U.S. Treasury bonds would also be deemed a target as well. So this war of words between the two doesn't seem to be subsiding. If anything, it appears to be escalating. But one thing is for sure, President Trump has realized the importance of reopening or trying to reopen that Strait of Hormuz. But at the same time, the Iranians also recognize that that is the key leverage point that they have over the global economy and in this war, and also don't appear to want to retreat on that front either.
What about Iran's ability to strike its neighbors and infrastructure in the region? What's the current state of play with that?
So the thing is, if you listen to some of the communication that has come through from the U.S. Central Command, from the Israeli IDF, they will maintain that they've had a lot of military success in the first 3 weeks of this war. We're on day 24 of the war, that they've managed to eliminate a lot of Iran's offensive and defensive capabilities, in addition to their nuclear capabilities as well. But what also has become very apparent over the past week is that Iran can still inflict a lot of damage using some of those lower cost drones. They've been relying more on those lower cost mass manufactured drones as opposed to ballistic missiles. And even with those, that's enough to cause damage, a limited amount of damage, intimidation. And furthermore, when it comes to the Straits, even though there have been questions about whether the strait is actually mined or not, it's the threat of transiting the strait that is keeping vessels away. And so far, Iran have managed to keep that leverage and that chokehold over the strait, and also vis-a-vis the Gulf infrastructure and key energy infrastructure sites that they've been targeting over the course of the past week. We just heard from the IEA chief, Fatih Birol, a short while ago, and he was saying that this energy shock is bigger than the prior two energy shocks that we've had, the biggest one since the 1970s, because it is both a gas and an oil shock. And he himself has said that over 50 energy infrastructure sites in the region have been targeted. And unless the outcome leads to some reopening of the strait, the angst on the energy market is likely to persist, which is why this has become a key focus point of the U.S. administration.
All right, Bloomberg Horizon's Middle East and Africa anchor, Jemana Beseche, there in Dubai. Well, our next guest runs EFG International, a global private banking group with more than $200 billion worth of assets. The company says it's been actively expanding in the Middle East, and joining us exclusively now is CEO Giorgio Pradelli. Giorgio, thank you so much for your time today. So you have been expanding in these Middle Eastern markets, including Dubai, Bahrain as well. So can you talk to us about how exposed you are to the current conflict there?
So first of all, thank you, Paul. Thank you for having me. Well, obviously, this situation is quite unprecedented. For us, clearly, we have about 60 people in the region, and obviously, the security and the safety is our first priority. Clearly, they are advisory offices, so our business is actually booked in Switzerland or eventually in Singapore. So from a business standpoint, not much to report. Obviously, from a humanitarian standpoint, is a very difficult situation.
Mm-hmm. And from a business standpoint, what types of conversations are you having with your clients at the moment about risk appetite and about how and when this conflict ends?
Well, that's clearly a very difficult question to answer. I think that the markets entered into this crisis at the end of February thinking it's going to be like June. After a couple of weeks is over. Now we are already the third week. The situation doesn't seem to getting to the end soon. The concern of many clients is that they will stop trading, they will stop transacting, and we're going to go to a risk-off situation. So obviously for us, diversification remains key. In particular, what is very concerning, I would say, is the level of bond markets. We have seen the treasuries going up and not a flight to quality as we have seen in other crises. So this is a bit very fragile, the overall situation.
Yeah, are you finding that cash positions at the moment are larger than they would normally be? Because obviously the US dollar's been catching a bid, one of the few havens in all of this. Are you seeing evidence of that? And what other evidence are you seeing of investors becoming more defensive?
Yeah, we see investors becoming more defensive, but I would say that the evidence is not yet going back to cash, but at the moment is stopping, is going towards more on the sidelines, risk-off stance. This is for our business is actually the biggest concern of all. If clients stop trading and transacting, this becomes an issue for us.
Is this a good time to be chasing dips, to be buying quality names and blue chip stocks?
Well, obviously, quality is always good, but at this stage it's very complicated to call because nobody knows how long this is going to last. We believe that it shouldn't last too long, but again, we were saying the same thing 2 weeks ago, and we are still here. So at the moment, as I said, there is more caution around the market. I don't see a lot of people chasing dips.
Well, you still have a job to do. Can you tell us what your clients are looking for in terms of, finding havens or just putting money to work in the current environment?
At the moment, we see that the clients that are actively trading, they are trading volatility. We see a lot of structured products being traded, and this is how people try to take advantage of the high volatility at the moment. Otherwise, it's more tactical, more than strategic, as I said, everybody is more looking at the situation. Geopolitics is becoming, I would say, dominating the markets. We always said that, private banking is geopolitical risk diversification. So with people moving, we see flows going into safe havens, but not really putting money at work at this stage.
Do you feel markets, well, stock markets in particular, are accurately reflecting risk at the moment?
I think that markets are starting to reflect risks. Yes, I think after 3 weeks, people are starting to realize that the situation is probably more concerning than we thought at the beginning of the month.
So you were mentioning at the start of this conversation how you have offices in the Middle East, small teams on the ground in Dubai, Bahrain, elsewhere as well. Longer term, once this conflict is over, and it is over, it will end eventually, how do you see the markets in Gulf states growing post-war?
Well, I believe that if the conflict ends in the next couple of weeks, the situation over time will normalize again. I think that the Middle East is one of the engines of growth, like Asia, for that matter, in our business and in the world in general. So I believe it's a function of how long this conflict is going to last. Again, I've been traditionally very bullish for the Middle East. I think I'm still very positive, but again, we need to see how long this is going to continue. And again, at the moment, we have not seen any action, any hostile action against the infrastructure, for example, desalination plants in the Emirates, for example. And clearly, this will be a key important element to watch.
Well, in the meantime, this conflict is putting up energy prices globally, the cost of moving goods around rising as well. What impact do you see this conflict having on inflation and growth in the longer term, particularly in the US?
Well, we see that clearly if the situation persists and given the damage to some of the infrastructure, the likelihood that even if the conflict ends in the next couple of weeks, some of the consequences will continue. This could create problems for the inflation, and this is why the bond markets are reacting as they are reacting. And so, all the forecasts that interest rates will go down, I think they have been put on hold in some markets. Close to home for you, interest rates went up. This was not particularly expected a few months ago. So I think that there is a general resetting of the whole macroeconomic situation. And again, the risk of a global recession is clearly increasing. This is not our base case, but clearly the risk has increased.
Yeah, in terms of Fed policy, we heard some remarks from Jay Powell over the weekend. He was praising Paul Volcker for raising rates during an oil shock back in the 1970s, even though it meant a recession. Do you see a chance of history repeating this year?
I think things have changed very much from the 70s. Markets are much more interconnected. I think it will be complicated, but again, at the moment we are in an unprecedented territory. So again, our advice is to reduce exposure in the asset classes that are more risky, and to wait at this stage. It's very difficult to make great calls. I would have said that probably the ECB would be the first to raise rates, but you cannot exclude that this happens also on the other side of the Atlantic.
So when you're looking around global markets and economies, which do you feel are best positioned to absorb the sorts of shocks that we're seeing at the moment? And, might I make a suggestion to get you started? Is China a good example?
Well, we in general, for our business, but in general for macroeconomic considerations, we are very positive about Asia. We've been positive about Asia. In our business, we serve wealthy clients. We believe that wealthy clients in this part of the world will continue to thrive, and entrepreneurial wealth will continue to be created. So I think that at the moment in Asia, it seems that there is an area of stability that unfortunately we don't see in other areas. So overall, this is a good place to be.
Yeah, so you are in Hong Kong at the moment. Can you talk to us a little bit about your agenda while you're in the region, where you're looking for opportunities and what your clients are saying there?
Yeah, I just arrived this morning, so a few hours back. So we are starting our week in Hong Kong and Singapore. Clearly, we are going to meet with clients. We're going to meet with our teams here. We have about 400 people in the region, and we're going to test the situation. Again, I think that as you can see from the screen, the markets continue to take a very negative stance. But as we were saying, in relative terms, this part of the world seems more stable. But coming back to the discussion about Volcker in the 70s, economies are much more interconnected than at the time. So the situation is very fragile, and you need to handle with care. I hope that.
Well, can I end by?
I wanted to say, I hope that everybody will see that.
Yeah, well, I'd like to end by asking you to make a prediction, if I can. If we were to have another conversation at the end of the month, how do you think things would look, and what's the biggest risk that's keeping you awake right now?
Well, as you know, my role is not to predict the future. Our chief investment officer does that. My role is to navigate through this difficult environment, and we have done that over unprecedented crisis over the last 5 to 10 years. Again, maybe it's more wishful thinking. I hope that the conflict will end soon, and then we're going to see the damage that we have had in the economies overall. So I'm not going to do any prediction. This is more a wish than a prediction.
All right, Giorgio, thank you so much for your time. Giorgio Pradelli, their CEO of EFG International. Still to come, China's premier promising to address global worries about the country's massive trade surplus, even as exports continue to soar. We're live from Beijing next. This is Bloomberg.
We take our trading partners' concerns seriously, and we are ready to work with all parties to promote the sound and balanced development of trade.
Chinese Premier Li Qiang there, speaking at the China Development Forum in Beijing. And for more, let's get over to Beijing, get to our Chief North Asia correspondent, Stephen Engel. So, Steve, what else did we hear from the Chinese Premier?
Well, he was saying, he knew his audience he was speaking to. That's multinational CEOs and chairmen gathered here at the annual China Development Forum. It's been held every year since 2000 or thereabouts, without the pandemic interruptions, of course, set up by the former Premier Zhu Rongji to kind of allow the foreign executives to come and ask the questions about the policy direction of the Chinese government a few weeks after the National People's Congress. This year is special because it was also the NPC essentially approved the next 5-year plan through 2030, which echoes a lot of what Li Qiang said. Opening up, he said China never seeks a trade surplus. China will continue to embrace free trade, advance opening up, further widen market access for services sectors, also imports of medical and healthcare products, and digital tech and low carbon services. So he said all the right things for a lot of these in the audience who essentially are dipping their toes and whole legs back into China, given, of course, the uncertainty policy-wise and the uncertainty because of the war that the international community possesses. And China continues to talk about stability and being a reliable partner. And again, we're rebalancing and opening up and importing more amid that $1.2 trillion record trade imbalance surplus last year. China is trying to court more investment and say all the right things, given the turmoil, what's happening in the Middle East right now.
Now, you also spoke exclusively with UBS Group CEO Sergio Ermotti. What did he have to say?
Yeah, so he obviously very concerned by what's happening in the Middle East. He says right now clients, the majority of clients are not having major asset reallocation because of the war, but he's concerned again, like we all are, where is the off-ramp, where is this going to end, and where are we going to be with fuel prices in the coming months, if not years. So I began my conversation by asking him his commitment to the China market against the backdrop, of course, of the potential energy shock and the prolonged turmoil in Iran.
This is basically the biggest topic we have been discussing lately. Of course, the good developments of China are somehow on the side for the second. But when I go back to that, I do believe that China will continue to have a pretty good growth driven by innovation and the desire really to address also the topics of climate through innovations. And so, but in a sense, that kind of growth may be derailed by what's going on right now in Iran. Energy prices are likely to stay high for the foreseeable future, putting some inflation pressure and also some pressure on the delivery chain or on the supply chain. And in that sense, the situation is a little bit unstable.
We're into the fourth week of this war with no end in sight, really. There's ultimatums out there. There are surely mitigation plans being put in place by businesses. What do you see as the direct cost to your business and your clients right now? And with no end in sight, how does that translate to mitigation advice?
But we saw clients already diversifying their portfolios early on this year. You saw much more dispersion in the way they were looking at maybe shifting away from more the AI technology to a more diversified portfolio. That was a good move considering what we see in the last few weeks. At this stage, clients are still, broadly speaking, calm. We don't see any major shift in asset allocation, but of course, this pressure that I mentioned before on the economy will start to wade into the market.
I think Ermotti pretty much sums up what a lot of the executives we've spoken to here are saying. This was not a quick war. It is not shaping up to be a quick war. It's hard to plan for, and those contingency plans are being put into place, or at least being developed right now, to mitigate the exposure, obviously, to the oil shock and to the dislocation of business interests, no doubt, in that part of the world. China, no doubt, coming up with their mitigation plans as well. They have vast interests, vast investments in the Middle East. They are a big importer of oil. So Li Chang talked about stability being important, but obviously China is also coming up with their mitigation plans, relieved a little bit by the fact that they have spent decades now already diversifying their energy source into more renewables.
All right, our Chief North Asia correspondent, Stephen Engel, there in Beijing. Thank you. Still to come, we are live at the Milken Institute Global Investors Symposium in Hong Kong, talking private markets, green energy and more with Indonesian Investment Authority CIO Christopher Ganis. Stay with us for that conversation. Up in a moment, this is Bloomberg.
Token efficiency. In order to build some token efficiency, we have to build our model for that GPU, for AMD. So that means that if you can work with the AMD technical teams, and then somehow we develop really efficient algorithms to put on their GPUs, so this is a huge gain. So that's why we closely talking with researchers and then make that come true.
David, what's been the impact of I guess, I mean, this plays into the broader chip story. How is it affecting your business, actually businesses right now?
Welcome back. You're watching Insight. Let's take a quick look at where markets stand as mainland Chinese markets head to lunch and Japan comes back online. Let's take a look at how Japan's tracking at the moment. Well, not well. Nothing's doing well, though. Let's be fair. The Nikkei off by 3 1/3% at the moment. We had the CSI 300 down by 2.3% as well. The Kospi, the worst performer in the region, is having a horrible day, off by 5 3/4%. Now, although, to be fair, the Kospi is still up 29% year to date for a little bit of perspective. All about the oil price, though, in the bottom right-hand corner there. Brent crude now above $112 a barrel, and that's what's really causing trouble for all risk assets everywhere. The yen at the moment, 159.54. We haven't seen a break through 160 since way back in 2004. Let's take a look at the rupee as well, because it fell to the worst level in 4 years on Friday as risks from the war mount. Things are particularly grim for India because it gets most of its oil from offshore. 90% of its oil is imported, 50% of its LNG, so a weak currency really just aggravates problems there. The rupee at the moment just below 94. Well, S4Capital founder Martin Sorrell says investors are not yet fully pricing in the impact of the Iran war. Speaking to Bloomberg at the China Development Forum, Sorrell said prospects for a longer conflict are rattling the executives that he's been speaking with.
Depends on how long it lasts. I mean, if it lasted 3 or 4 weeks, maybe limited damage. But if it goes on any longer, I think quite significant damage. I was on a call with a few CEOs about 24, 48 hours ago. A lot of worried people, because the markets to date have really underestimated. I mean, maybe on Friday we saw some more realism creeping in, but
so there's more pain in the S&P.
Well, there should be, I think, in theory. I mean, the number of people on the call I listen to, and I'm looking at stuff that's more publicly available, I think the general view is the markets have underestimated so far. They're betting on it being a 3 or 4 week war and not lasting much longer beyond that. But it certainly doesn't feel like that. The off-ramp, I hate that phrase, but the off-ramp is not a clear one. I mean, we're here in China. Some people posit maybe the Chinese can act as a diplomatic help.
They've resisted that. I mean, they've resisted sending, obviously, any kind of military aid to the Strait of Hormuz.
I was referring to diplomatic intervention or help, but it doesn't sound as though they're keen to do that either. So
they want stability too. They're not necessarily. Would you feel that the Chinese are saying, "Hey, this is our advantage here"?
I don't know whether they're saying it's an advantage. I think it's probably a disadvantage. I mean, their dependence on oil is significant.
Diplomatically, though, I mean, obviously, the whole world gets oil shock.
Well, I mean, just from a personal point of view, I think, diplomatically, it would be good for China to be seen as the opportunity, or grasping the opportunity to try and develop a political solution, a diplomatic solution. So I think it's in their interests economically and, dare I say it, politically, to be seen to do that, as a force on the international scene, as a peaceful force on the international scene. I'm not talking about military intervention or anything like that. We have to see how this pans out. It's so unpredictable. And going back to your fundamental question, the one thing we don't need is this uncertainty. I'd rather dribble along at a lower growth rate with some certainty than have this volatility.
Sounding like the Chinese government a little bit. That's kind of, you kind of get Li Chong saying the same thing, right? Look, they're consistent in messaging.
Yeah. No, I think the uncertainty. I mean, we've moved into a different age. You and I have talked about this for a number of years. I mean, the golden age of globalization probably over. Fragmentation. You've got U.S.-China relations is an issue. You've got, and obviously the postponement of the meeting, to my mind, is not a good signal.
That's S4Capital founder Martin Sorrell speaking to Bloomberg's Stephen Engel in Beijing. Let's get over now to the Milken Institute's Global Investors Symposium in Hong Kong. Bloomberg's Min Min Lo standing by with our next guest. Min Min.
Hey, Paul, what a day to be holding this symposium, obviously, with markets are very choppy. Iran has been top of mind among the conversations here at the symposium. And joining me now is Christopher Ganis, the CIO of the Indonesian Investment Authority, which is the country's first sovereign wealth fund with about $10 billion worth of assets. Chris, great to have you with us.
Pleasure.
Yeah, but my first question is, what is the impact in terms of pullback in investments that you're seeing because of the Iran war?
I think we have to look at that with the proper lens, that when we look at from the public investors, I think the market will definitely take a pause and trying to understand how the noises built into the more longer term signal. When we look at it from the private lens, especially from the Indonesia side of it, the recent event, the tragedy that continues to take place in the Middle East will only accelerate some of the trends that we are seeing, especially as it relates to around deglobalization and the creation of multipolar world, which will have much more impact in how we look at investments in the medium term and the long term. But overall, I think we have to look at this with our heads up and understand that every structural change will bring benefit, disadvantage, advantage, and we just have to take it all on with a collaborative effort.
It's certainly a very challenging environment right now. Also, at the same time, a couple of weeks ago, Fitch Ratings downgraded its outlook for the Indonesian market. How much impact does it have on your ability to attract foreign capitals and negotiate valuations?
I think that's something that we have to also evaluate as the government react and adjust their fiscal policy. I think our government have provided a couple of quick responses to ensure that we maintain our fiscal discipline. Our monetary policy is also being adjusted in reaction with the global central bankers all around the world. I think synchronization between the fiscal, monetary, and the behavior of private sector will be very critical. Definitely, it's not an easy time. I don't want to be any central banker around the world at this point.
Yeah.
But we just have to do what we can do. And obviously, it will require more time to explain that if we play our card right, specifically from Indonesia point of view, if we can influence the behavior of some of this private sector, we can actually turn this around for our advantage. Indonesia is true, it is a net oil exporter, but it is Indonesia is a net oil importer, but it is a net energy exporter. It is a net commodity exporter. That's all the could be for our benefit, right? Because I think at this point, everybody, sovereign, private players are gonna try to go for more inward-looking, creation of independence in energy, creation of independence in food, and the likes, right? So this collaboration will continue to be at the forefront of everybody.
Yeah, but Fitch Ratings also specifically pointed out the creation of Danantara, which is the second sovereign wealth fund, that blurred the fiscal boundary. How difficult is it then to separate INA's credit story from Danantara's credit story?
I cannot speak much as relates to Danantara. I am not coming from their point of view. But when we take a step back and understand why Danantara was created, it was created with the mindset of having more coordination and increasing efficiency of the state-owned enterprise, with the mindset that some of these financial gain can be utilized in a more effective manner, right? And obviously, when you want to look at that from Fitch point of view, I think you cannot look at it in a vacuum just by singling out Danantara, because keep in mind, they've only been there for a year,
yes,
right? And we haven't really quite seen the transmission of the effectiveness of their ability to turn around the state-owned enterprise, as well as some of the projects that they just start investing.
Yeah.
And I think if you keep in mind our history, now we can say that we are comfortable in producing some of these profit, investments, collaboration, but it took us 5 years to get here.
So your primary mandate has been to attract foreign investors as a co-investor into strategic sectors in Indonesia, including infrastructure, green energy, and the like. What are some of your biggest priorities now?
When we look at these priorities, we always put it into two buckets. The immediate priorities where investors are ready to come in, and the priorities of the sector that investors will have to take a longer term view as scale is being created in the industry. I mean, for us in the immediate term, digital and digital infrastructure comes into mind right away. We are at the early stage of creating the foundational layer for AI development, which it will be a sector that is supported by each of the sovereign, because they want to make sure sovereignty in data. When we look into the medium and longer term, the crisis that happened in the Middle East is also a strong reminder that we need to be able to diversify out of fossil, right? That's when renewable energy, something that is already available in Indonesia's own backyard. I mean, I think there's an estimate out there, if we can fully harness all the renewable, we can get up to 1 terawatt of power, which is enormous amount, right? But that is longer term because you need a scalable platform, you need a scalable grid to be able to power through the Indonesia, which is an archipelago by itself. That also presents a challenge.
Speaking of the Middle East, I understand they have been in the past few years your biggest source of foreign capital. Given the Iran conflict, are you looking to diversify or pursue other sources of foreign capital now?
I wouldn't say diversify is the right word. Middle East will continue to be a very important partners of ours. I think our approach when picking our partners is always division of labor. So we will provide the local expertise with the expectation that our partners will provide the capital, will provide some of the know-how. So we are quite agnostic when it comes to the partner selection. I do strongly believe the conflict will be resolved at one point. And what is most important for us is how do we collaborate? How do we help each other once that conflict is resolved? How do we rebuild? And how do we get back to where we want it to be, a more harmonious society?
Chris, you come from a private credit background, and I know when you joined INA, you were talking about how INA can really play a role in that gap where banks don't fulfill and where bond markets are closed. So I wonder how your private credit portfolio has been performing so far, especially given we have seen a lot of scares in that sector.
Man, I think that's a very good question, and I'm glad you brought it up, right? Because private credit, for me, is a word that has been relatively oversimplified. But let me first address on why private credit is not really high on my radar risk from where I'm sitting. Private credit in Asia is a product that comes in, that it was created because there's an actual need. It was meant to complement the existing capital provider, the banks, the bond market, and the likes. While private credit in developed market are designed more to compete with them because of the regulatory capital constraint from the banks. So the genesis why it existed was already different, right? There's more natural need for private credit in Asia. The second part is, unlike some of the financial crises that we have seen, I do not see private credit in Asia and private credit in the West have the contagion effect, right? So it's going to be relatively more contained. So you don't really see the systemic risk becoming something that will take the front and center. And now, when you put it all together and start going through the numbers, when you look at the default rate of the high yield market in some of the developed markets, the US, for example, maybe we'll refer back to 2008, we're starting to see default rate as high as 9-10%. That is worrying. But right now, the default rate is around 2 or 3% at most. The issue here is not so much the underlying credit itself, it's more that the redemption, the liquidity issue that is being created by the investor of the product. So not so much an underlying problem of the asset class itself.
Right, so there's still a bit of a fear there.
There is a bit of fear, but I think this is a good fear. That is now the private credit is taking more of a phase where it goes back to discipline itself, maybe a little bit less on the covenant light kind of product, more thoughts in terms of the investor base and the pipes.
Just quick question, given the rupiah has been under a lot of pressure, how are you hedging that currency risk, and does it change the sort of deals that you're pursuing?
No, I mean, for us, when we look at private credit, given the tenor is shorter, unlike the 7+9 years, we don't really take hedges. A lot of our private credit investments are denominated in hard currencies, US dollar, Singapore dollar, or Australian dollar. And not because we have preference for that, it's because every investment that we have, we need to do it with co-investment. And our co-investors and private credit typically plays in the hard currency. Eventually, I think we will develop an IDR currency, private credit, but for the time being, mostly in hard currency. Now, when we look at the underlying risk, we typically pick companies that actually have growth prospect, as well as a bit of a natural hedge as relates to the hard currencies.
Yeah. All right, thank you so much. Always insightful to have you on. That was Christopher Ganis, the CIO of Indonesian Investment Authority at the Milken Investment Symposium in Hong Kong.
Thank you very much.
All right, thanks very much, Min Min. Still to come, Narendra Modi stresses the need for secure shipping lanes in a call with Iran's president as the war triggers an energy crisis rippling through India's economy. We'll have more from New Delhi in a moment. This is Bloomberg. Welcome back. You're watching Insight. Let's check the open of the India markets just a few minutes ago. Let's start with the rupee. In fact, that has fallen to another fresh record low. Hit a low on Friday. It's continuing to slide. We also have a lot of weakness on the market open as well. Perhaps unsurprising, we're seeing weakness everywhere at the moment. It's the bank index that's leading the way south right now, off by 2.4%. The Sensex off by 1.85%. We're seeing yields rising as well as we are across other nations as well. We've got the 10-year yield now at the highest since January 2025. Well, stock volatility in India obviously remaining elevated, even as fear gauges ease for some Asian markets, including Korea and Japan. Now, this comes as investors signal unease about the nation's energy exposure, high valuations, and also renewed focus on corporate governance troubles. Let's get to our senior Asia equities reporter, Abhishek Vishnoi. So, Abhishek, India's volatility gauge staying a lot more elevated relative to its near-term history, also versus a lot of other markets as well. So what's the market seeing in India that it's not seeing in, say, Japan or Korea?
So, it points to a deeper, investor angst against India stocks. It points that there might be more pain ahead. It shows that, the pre-existing conditions, even before the Iran war, there were a lot of outflows from India, on concerns ranging from high valuations to a weakening currency, a sort of subdued earnings growth. Those concerns still continue, and, Iran war is sort of exacerbating those concerns. So all in all, it means that even if Iran war risk sort of passes away, yes, India with other markets would see gains, but there are a lot of structural issues which India needs to tackle to get back on track. Otherwise, in terms of exposure by foreign investors, it has largely been reduced to a funding market where money sort of started rotating from domestic local demand-driven India story for the short term to chip stocks in Korea, China even, and Taiwan.
And let's talk about oil as well, because of course India imports about 90% of its crude, and the rupee is also weak. So how vulnerable is the market to a prolonged oil shock, and is this now a structural risk rather than just a short-term one?
Yeah, it is getting there. It is becoming like a structural risk for the market. I mean, everyone in the world except US is sort of getting impacted because of higher energy prices. So India is not alone in that boat, but it can become a structural factor if oil prices remain elevated for a longer period of time. A longer duration, given India is largely dependent, on Hormuz for a lot of its supplies of oil and gas, what essentially means that, deficits would rise, currency currency would weaken further. So it will seep into the already sort of a little bit fragile sort of macro situation for the near term. It won't derail the long-term story, in terms of consumption, etc. But for the near to medium term, it means there might be more outflows happening. So that means, sort of a stickier geopolitical risk premium, or in other terms, lower valuations. So, the valuation multiple that India is commanding right now, they've come from, high of 22 times to about 19 times. They can, go down further. The premium to emerging markets, which are trading at about 12, 13 times, can also erode further.
So foreigners have also been selling stocks, and this was a trend we saw even before the Iran war got started. Is that getting worse, or is the situation improving?
Actually, it is getting worse, and it look worse when you look at data in terms of redemptions. What you can see in terms of selling, a lot of selling has happened. About $8 billion have moved out, just in the last few weeks, and that adds to the billions of dollars which have already been sold out even before the Iran war. But if you look at the redemptions data from EPFR, that showed that the amount of sum that have flown out of India dedicated funds was the largest on record since EPFR started compiling that data. It's probably an even bigger shock than 2008 in absolute terms. The only thing here is that as a percentage of market value, from where India is to where it used to be in 2008, it looks relatively small. But by all means, this doesn't look like capitulation kind of level. So the outlook remains cautious for the near term. Nomura just came out with a report in the same context, and they put it nicely how a lot of money has already moved out, but near-term stance remains cautious on India given the vulnerability the nation faces in terms of its economic exposure to imported oil.
All right, Bloomberg senior Asia equities reporter Abhishek Vishnoi there. Here are some of the other stories that we're following. The US reportedly telling foreign officials it will not reschedule the summit between President Trump and Xi until the Iran war ends. Politico says the US will propose new dates for the meeting after the active part of the conflict is over, citing a Washington-based diplomat privy to summit planning. Trump had previously said the summit would happen in 5 or 6 weeks. The US is deploying immigration agents to airports to help ease delays caused by a budget impasse. Border Chief Tom Homan says the agents will perform non-significant tasks and won't be using X-ray machines or scanning luggage. TSA employees have gone unpaid for 5 weeks due to the partial shutdown, leading to lengthy delays at US airports.
We're simply there to help TSA do their job in areas that don't need their specialized expertise, such as, screening through the X-ray machine. Not training that, we won't do that. But there are roles we can play to release TSA officers from the non-significant roles, such as guarding an exit, so they can get back to the scanning machines and move people quicker. And we're just simply helping our fellow officers at TSA.
A senior Cuban official says the country is preparing for a possible military assault. The deputy foreign minister made the comments to NBC News as President Trump increases economic pressure on the government in Havana and suggests it could be the next US target after Venezuela and Iran. Still to come, the head of income strategies at Pendal Group, Amy Seapatrick, tells us why she thinks the war in Iran is a bigger threat to growth than inflation. Plus, we talk to Indian drug maker Dr. Reddy's laboratories about their plans in anti-obesity treatments after the approval of their injection for diabetes. More to come in our next hour of Insight. This is Bloomberg.
Only as of today, we lost 11 million barrels per day. So more than 2 major oil shocks put together. Plus, after Russia's invasion of Ukraine, the gas markets, especially in Europe, we lost about 75 billion cubic meters, 75 BCM. And as of now, as a result of this crisis, we lost about 140 BCM, almost twice.
Welcome back. You're still watching Insight, and that was the IEA Executive Director, Fatih Birol, talking about the impact of the Iran war on energy assets. So let's take a look at that impact right now. We've got Brent continuing to rise, 112.83 a barrel at the moment, and that's causing all that red on the screen that you can see. The yen, particularly weak, closing in on that 160 level. We haven't seen that since way back in 2004. The rupee continuing to soften as well, hitting a fresh record low a short time ago. And things are particularly grim for India. Not only does it have a weak currency, it imports 90% of its oil and half of its LNG. Elsewhere around the region, unsurprisingly, we're seeing a lot of pressure on equities. The Nikkei off now almost 4%. The Kospi now off almost 6%, although I gave some context on the Kospi a little while ago. That's still up about 29% year to date. So if you take a longer term view, perhaps things aren't terribly bleak, but don't get me wrong, they're still pretty bleak. For more on that, let's get to Bloomberg Markets Live Executive Editor Mark Cudmore. So, Mark, talk to us a little bit about some of the market action that we're seeing today.
As you say, Paul, it is quite bleak in the short term. And I think, it can unfortunately get bleaker still. I think the underlying idea here is that equities, very unusually, have both a negative underlying kind of trend as we go through time, plus negative convexity. And let me explain that. If stocks normally are an inflationary asset over long periods of time, you expect them to go higher in this because fiat currency slowly loses its value and they're priced in fiat currency. What we've got at the moment is because positioning is still priced very optimistically on a conflict with no visibility, is that people have retained their long positioning. And every day that the conflict extends and oil prices stay high, the impact from that energy shock on both negative on growth and higher on inflation, the stagflation impulse, grows and becomes slightly worse. And so the future outlook for stock earnings becomes slightly worse, which means that every day investors are holding on to positions, but the situation gets worse. They need to kind of slowly, ultimately sell down is what that means. And yet we've actually got negative convexity because people are refusing to kind of capitulate and abandon. That means if we do get, a clear shock that, hey, the strait's not opening maybe for months, that's the possibility out there. We have no idea on how the trajectory of the war. Well, then we could still go significantly lower, precisely because actually something else you just mentioned there, Paul, the idea that we saw extraordinary gains into the conflict. The backdrop for the conflict was one of the most bullish environments for global stocks I ever remember seeing. You have extraordinary fiscal stimulus being provided by the major governments around the world, and you have a capex bubble from the private sector as well in the inflationary stage. So the private sector and public sector pumping money into an economy, global economy that's growing just fine. Meanwhile, monetary policy is easy. So a lot of liquidity out there. It was a perfect environment. But we have a real conflict in our hands. And investors are going, well, so bullish before, I don't want to give up on that. And Trump's got an incentive to solve it before the midterms. He does have an incentive to solve it, but he's not the only protagonist here. There's not just Israel, but importantly, there's Iran. And it's unclear what their incentives are or why Iran would want to have an off-ramp quickly, when at the moment it seems to be gaining an upper hand in terms of its impact on the global economy. So at the moment we're positioned very optimistically, but the outlook's getting progressively worse. So that's why we've got an underlying negative trend with negative convexity in terms that we might really accelerate on the downside at some point.
Well, Mark, talk to us a little bit about havens as well, because we're seeing the US dollar getting a bid, but pretty much nothing else that you'd traditionally call a haven. What's going on?
Yeah, that's exactly as you'd expect from this kind of Middle East energy crisis. In fact, my colleague Skylar Montgomery Koenig wrote it on March 1st, the Sunday before markets opened after the impact. The dollar will be the only haven in such a crisis, and it's logical. Obviously, it's an inflationary shock, so you can't buy treasuries because you're going to see yields go higher. So it's never going to be good on treasuries. It can't be good for gold because you're going to see dollar both gain because it's a net energy exporter, and you're seeing yields higher. So the two marginal inputs into gold are turning more negative. And also, if you bought gold on a Middle East conflict, on the geopolitical risk, well, as soon as the invasion happened and you have a war involving about a dozen countries in the Middle East, fully involving the US, well, then you've already had the conflict. So pat yourself on the back, take profit on your gold trade, and you're going to get out, because escalation from there basically requires things that we really don't want to think about, things like a nuclear strike and stuff like that. So, you've already had the geopolitical risk trade, so that's behind you. So gold should never be a haven in such a situation. The only one that works as a haven for such a conflict is the dollar, and that's been expected a couple of weeks ago. So I would say that markets are working perfectly as expected in this regard.
All right, Bloomberg M Live Executive Editor Mark Cudmore, thanks for your analysis there. Well, let's get some more now. Bring in Amy Patrick, Head of Income Strategies at Pendal Group. And Amy, against that backdrop that Mark just gave us, and bleak it was, what do you feel the biggest risk is from this enduring conflict? Is it inflation or is it a risk to growth, or both?
Well, I've been looking at the movement in bond yields over the last couple of weeks, so since the end of February until now. And depending on where you look on the US curve, break-evens versus real yields, the proportion belonging to the yield move is a little bit different. But let's just look at US 10-year as a benchmark. You know, break-evens have moved something like less than 15 basis points. The rest of the move has been real yields. And I was thinking about it this morning, and I was thinking, at least in the 10-year parts of the curve, the bond market is not pricing in, massive destabilizing long-term inflation because of this shock. But at the same time, it's certainly not thinking about recession if real yields have gone up this much. And bringing in my sort of emerging markets experience from, years ago, it kind of feels like this is what happens to bond markets in EM when we're starting to worry about a debt crisis. And I think the market's definitely skipping, a few steps ahead, thinking, well, this crisis is going to lead to both, as Mark just said, risk to inflation on the upside, risk to growth on the downside. Governments don't want to see that recessionary outcome happen and therefore stand by to open the fiscal taps even more than they're turning right now. And as a result, more debt, and then let's worry about debt sustainability. But then I still can't square that circle, to be honest, because then I think, well, shouldn't 2s, 10s be steeper by now if we're pricing in a higher term premium? And that's certainly not the case. If anything, the curve's flattened quite a lot.
Since we're talking about debt, let's just take a brief detour there, because last week the US debt pile topped 39 trillion. It's spending $2 billion a day prosecuting this war. At what point does this become a problem?
It's not a problem. I mean, maybe this is what the real yield move ultimately is about. I mean, it could be that in the background. I mean, I do think that when shocks like this happen, it does two things. In the first instance, it alerts markets to where positioning's been most crowded, most overstretched. But in the second instance, I think it wakes us up to problems that we didn't think mattered so much when volatility was low. So maybe this debt sustainability worry is coming to the fore again, which is why the move in real yields has far surpassed the move in break-evens. But at the same time, I go back to what am I worried more right now? Is it inflation or is it growth? When you listen to central banks talk, I mean, we've had a whole bunch of them have meetings and decide on policy over the last week and a half or so. They've all pointed to the crisis in the Middle East, the shock to the price of oil, and have, at least spoken more hawkishly, if not acted more hawkishly. But over the much longer term, what you can see in the relationship between oil price moves and core inflation, which is what all central banks target, is that there is no enduring and reliable relationship. There are times when oil does lead to an inflation shock. There are more times than not when those oil prices don't feed through into core inflation. So I think what the central banks are trying to do is manage inflation expectations, right? Because we're all filling up our cars at the pump, seeing how much more it's costing, and we're all starting to worry about 2022 all over again. So I think these hikes or these hawkish murmurs are definitely an attempt to sort of, get their hands around global inflation expectations.
Is that all it is, particularly when we look at the Fed at the moment? Is it just hawkish rhetoric, or do you feel that maybe the case for easing later in the year might still be intact, or is that vanishing very fast?
The US is a funny one to me. I say that, on balance, I do worry much more about the growth side of the picture than the inflation side of the picture. But in the US, I do wonder whether one of the things that has been a problem for a while, but now this shock has made us all focus on it, is the fact that since June of 2024, US inflation, at least core PCE, what the Fed targets, has been stuck. It's been stuck far closer to 3% than it has been anywhere near their 2% target. And this has been a problem that the markets, since June 2024, has been really willing to brush over, thinking, we'll get there. It's slow and it's gradual, and the Fed is right to keep cutting into this very sticky inflation picture because it's just a matter of time. And now what this this war seems to have initiated is this mentality in markets possibly that there is a fundamental inflation problem with the US. Maybe they did cut too many times and maybe some hikes would be warranted. Quite frankly, I'm surprised it's taken this long for even the hint of hikes to be priced into the US curve.
Now, correct me if I'm wrong. I think you previously said that less policy guidance might be a good thing. Is that correct? Yeah.
Yeah.
How do you think markets would react, though, to hearing less from central banks at a time like this?
I mean, they're going to stay volatile regardless, I think, right? Because it's exactly in these types of times when I don't think central banks have a handle on this situation any more than any of the rest of us, quite frankly. And isn't this the worst kind of time to be giving a lot of guidance? Because quite frankly, just like the RBA did in 2021, you can be very firm in a moment in time about something, and then the markets will take that and run with it, only to be, materially surprised down the road.
Yeah, don't know, though, isn't very good policy guidance. That was not very reassuring. The
RBA does a pretty good job at it, though, don't you think?
Yeah.
I mean, Michelle Bullock, in those press conferences, does a very good job to reiterate what the central bank's work is and tries pretty hard, despite whatever questions she gets, to stay firm in terms of the type of guidance that she gives.
Well, look, since we're talking about Australia, one of the things that the governor talks about often is wage increases in Australia. Do you see this happening, though, to offset rising CPI? Or?
I don't see that kind of tightness in our labour market. I mean, you can look at sort of high-frequency data sources like Seek.com, and quite frankly, wage growth in the private sector has been very, very orderly, very contained. It's not a wage price inflation spiral that I see, which is why, I bring back the link ultimately to from the oil shock that we're seeing now to core inflation, which is far more driven by wages and through the services side of the economy.
Look, let's wrap up by, assuming this global growth slowdown, talk a little bit about IG credit spreads. At what point do you feel that they're no longer compensating for the risk of a hard landing?
Well, they're not compensating for the risk of a hard landing now, quite frankly. None of the credit asset classes are compensating you for risk of a hard landing. I'm personally incredibly surprised by how healthy the demand appetite in US credit has been, especially over the last 2 weeks when the conflict, noise has been heating up, if anything. I mean, the amount of demand for new issuance, the fact that new issuance is still getting done in the US market tells me that there's still far more appetite out there. And I think, again, this is markets and risk markets, including credit, looking through the state of the crisis and saying, you know what, at these all-in yields, credit is still a good income asset to own.
All right, Amy, thanks so much, as always, for your analysis. That's Amy Patrick, Head of Income Strategies at Pendal Group. Still to come, China's premier promising to address global worries about the country's massive trade surplus, even as exports continue to soar. We're live from Beijing next. This is Bloomberg.
We take our trading partners' concerns seriously, and we are ready to work with all parties to promote the sound and balanced development of trade.
China's excellently talented developer community is pushing the limits of innovation every day. And we're inspired by the many ways Chinese developers are using technology to build tools that help people learn valuable skills, manage their health, and bring new ideas to life.
Energy prices are likely to stay high for the foreseeable future, putting some inflation pressure and also some pressure on the delivery chain or on the supply chain. And in that sense, the situation is a little bit unstable.
Some of the voices there that we've heard out of the China Development Forum in Beijing. And for more, let's get back to Beijing and our Chief North Asia correspondent, Stephen Engel. So, Steve, what else did we hear from Chinese Premier Li Qiang and Apple Chief Tim Cook?
Yeah, well, first of all, on Li Qiang, this is the opportunity the Chinese government has had since 2000 when it was set up, the China Development Forum, is sort of to give the opportunity for foreign multinational corporation heads to come to China and for Chinese leaders to kind of express, flesh out the details of what took place at the National People's Congress a couple of weeks ago. This year, in particular, is more acute because they also, the National People's Congress, essentially ratified the next 5-year plan through 2030, which has to do with a lot of the themes that Li Qiang talked about today: opening up, importing more, being more, adopting more AI practices, and essentially being the reliable partner in global trade and promoting multilateralism. Again, sort of a veiled comparison to what the United States did over the last year with its tariff regime. But at the forefront of all these talks and these speeches is, of course, the war in Iran and the concern that a lot of the companies and the Chinese leadership have as well, the inflationary aspects of the oil shock and the like. So it's never easy doing business in China. This just adds, of course, another uncertainty with what's happening in the Middle East. But you just heard Tim Cook. He said all the right things, just like Li Qiang tried to say all the right things to the group of multinational CEOs. Tim Cook, keep in mind, Apple is under pressure. Just a couple of days ago, in fact, they were semi-front page news, essentially from the People's Daily, criticizing Apple for what they called monopolistic behaviors as it relates to their App Store. And Apple just a few days ago as well did lower the cost, the price it charges to developers for apps on the App Store, again, to perhaps assuage the concerns that regulators have for Apple's pricing policies on the App Store as reflected through the state media organ, the People's Daily. So again, that People's Daily article essentially veiled threats of perhaps more pressure from the Chinese government if Apple does not break from its alleged monopolistic behaviors in relation to the App Store. So again, Tim Cook saying the right things. He praised Chinese app developers and again is again at the CDF, as he has always been a consistent participant here.
Steve, you also spoke with the Fortescue Metals CEO, Dino Otranto. What did he have to say?
Well, Dino, quite outspoken about what's happening in the world. We do know that his chairman, Andrew Forrest, has been, pounding the drum of energy diversification for quite some time. He has, championed green hydrogen and the like. And so what's happening in the Middle East and what's happening around boardrooms around the world is a recalibration as well, how to deal with higher oil prices, higher energy prices, and whether that will spur an energy transition. Well, of course, we all know that Fortescue Metals is primarily, its earnings are derived from iron ore, and that could be impacted as well, Dino said, and this is what we had to have a conversation about, whether China's impact from the various shocks around the world will impact iron ore demand.
Well, I think as Premier Li Qiang mentioned yesterday, the stability is core and front of the 15th five-year plan. Amongst that, the diversification of its economy in China. And we're seeing, certainly from Fortescue's perspective, the direct benefits of a rebalanced economy here in China. On the demand for our product side of iron ore, we continue to see a flattening but strong demand on a much, much bigger economy here that China's established over the last 20 years. But more importantly for us is a diversification from its traditional growth sectors of property into automotives, into technology, and really what we're here to talk about, particularly today, is its transition away from an oil-based economy. And we see significant amounts of steel going into that change, as well as other commodities like copper.
Well, that's a good point. Before we talk about that energy transition, let's talk about the prospects, because none of us know when or where the off-ramp is for this war. There could be recessionary pressures, not only on the rest of the world, but China. They have resilience built in, but it can only last so long. So where are you gaming out your contingency plans if indeed China does, like much of the world, if we go to $300 or beyond even the price of oil, if there's recessionary pressures in that?
Look, most mining companies around the world are heavily reliant on the supply of oil to run their operations. Our peer group, every 10-cent change and only 10-cent change of the oil price will impact us all by about $500 million. And you can take the most educated guess probably of all of us, Stephen, on where the oil price will end up. This has serious ramifications for our industry. And I want to bring that point to attention to everyone around the world. This is not just the mums and dads being impacted by fuel bowser costs. Every part of our sector is going to be impacted by this. And that is exactly why we at Fortescue are doing what we're doing. In the next 2 years, we'll be completely off diesel. That's nearly 1 billion litres equivalent. Now, we're doing this for climate, we're doing this for security, which is very topical now, and fundamentally we're doing this for economics. At the prior long-term oil price, we're talking about another $3 to $4 off our cost base. We're already in the box seat. Taking another 15 to 20% off our cost base would create now an expansive distance between us and second place.
What does it mean for your diversification into your product mix? Almost all of your earnings are from the core product, iron ore. You've been wanting to get further into copper, as the rivals BHP and Rio obviously have and want to as well. You just purchased the last bit of Alta Copper in Canada with their interest. How do you see that offer mix and the product mix changing given these headwinds?
Look, I think first and foremost, we talk about the majority part of our business, which is iron ore. And as I said, the diversification that we're going through will continuously bring us to the lowest end of that cost curve, which positions us well from a market size at 200 million tonnes, products now that cater at the high, mid and low grade sector. And as you've said, we've concluded our acquisition of Alta Copper. It's a Canadian-based organisation, but its asset is in Peru. We've been there for a number of years. I think it hasn't got the attention of the world media yet because we didn't pay that much for it.
Yeah.
But it is one of the largest untapped copper deposits yet to be properly explored and developed on the planet.
And Paul, that's pretty much a wrap of our coverage, very timely coverage here at the China Development Forum. We're packing up, we're heading off to Boao in southern China, where we will continue the conversations about the shocks from the Middle East war and the possible energy price increases and as a tax on corporates doing business here in China.
All right, good stuff. Thanks, Steve. Our Chief North Asia correspondent, Stephen Engel there in Beijing. Still to come, Indian drug maker Dr. Reddy's launches the country's first semaglutide injection. We'll ask their branded market CEO, MV Ramana, about future plans in the anti-obesity market. This is Bloomberg. Welcome back. You're watching Insight. Indian drug makers are rolling out generic versions of Novo Nordisk's blockbuster weight loss and diabetes medication, Ozempic. Now, this comes after its patent expired, with prices of duplicates already as low as $14 a month. Let's get to our India consumer and healthcare reporter, Satviki Sanjay. So, Satviki, what's the price erosion for the diabetes and obesity treatment in India after this onslaught of generics? And what's the impact going to be on Novo Nordisk and Eli?
Hi, Paul. Yes, you're right. The patent for Novo Nordisk semaglutide, the key ingredient in Ozempic and Wegovy, expired in India on Friday, and Indian companies, as many as 8 to 10 Indian companies have already announced their plans to launch generic versions. As you correctly pointed out, the price of these drugs have so far been as low as $14. If you compare this to the prices of Novo Nordisk in India, It's about $100 right now, about $90 to $100. And the same is for Eli Lilly's Mounjaro in India, which is used for the treatment of obesity. This obviously means that there's a big class of people in India who have been so far reluctant to try on these obesity and diabetes medications, who will now be more comfortable shelling out this money for the treatment. It means that there would be more users willing to try on the generics, and both Novo Nordisk and Eli Lilly's Mounjaro would at some point might be considering price cuts or other programs to help onboard more people on the innovator medicines versus the generic drugs. It will be very interesting to see how the market plays out over the next couple of months as healthcare providers, doctors, and the industry really pushes these medications to India's vast obese and diabetic population.
Yeah, definitely the lower price makes this a lot more accessible. So is it possible to gauge how big the market could get for these drugs?
Yeah, India is the third largest obese country in the world after China and the US, and also the second largest diabetic country after China. Estimates have started coming in. Jefferies sees the market already at $500 million, and it says the market could be as big as $1 billion, with the right pricing, the right adoption, and government incentives. So that's the estimates we have right now. But as more drugs keep coming in the market, we'll have a clearer picture.
Your patents have expired in other markets as well, like Canada, China, Brazil also. So what are we watching out for going forward?
Yes, the patents have expired for major countries across the world this year, including China, Brazil, Turkey, and Canada. Canada was the first where Novo's patent expired earlier this year in January, but the health regulator there has not approved any drugs for sale in that country. This means that India is effectively the first market where you see an onslaught of generics. So, countries across the world, the companies, regulators, everyone sort of watching out for what the adoption is going to look like, one, and also secondly, what will the second order effects of such a widespread adoption of these medicines, what could that look like? So there would be a couple of things that countries across the world will take a cue off from the rollout of these drugs in India. The first market,
effectively. All right, Bloomberg India. Okay, Bloomberg India consumer and healthcare reporter Satviki Sanjay there. Well, let's get further insights now. We're joined by MV Ramana, CEO of branded markets at Dr. Reddy's Laboratories, one of India's top drug makers, and a recently launched Obeda, a generic once-weekly semaglutide injection for type 2 diabetes. MV, thank you so much for joining us today. I just want to start by clarifying, do you have regulatory approval for this yet? And if not, when do you expect to get that?
So we have the regulatory approval for India, and post the regulatory approval, we were the first company to receive the approval and then launch the product. We have launched the product at 70% discount to the innovator, and the product is today available all across India.
Well, it's available at a very attractive price point as well. 1,290 rupees, I believe. That's about $14 for a month's supply. Can you tell us about what kind of demand you're expecting?
So if you see, I think Satviki did mention that India today is the second largest pool of patients for diabetes and third in terms of obesity. So there is a significant need to use this product, because this product not only is helping the diabetic patients, but also the patients with obesity and other comorbid conditions. So with the way in which Dr. Reddy's and the rest of the pharma companies in India have priced the product, they should help the HCPs to offer the product to a large section of the patients in India who will get the benefit across the length and breadth of the country, not only in the metros, but in terms of tier 1 and the tier 2 cities. And then you would start to see a significant jump in terms of the generic semaglutide sales.
How much of the demand do you expect to see coming from diabetes patients, and how much would you expect to come from people who are excited about this medication's anti-obesity properties?
So in terms of the product, both, I think there is a clear need in both diabetes and obesity. Having said that, when it comes to obesity, we would need to have a lot of conversations with HCPs, bring in the current thinking internationally on how the product should be used and where the product should be used. And hence, I would see that the initial pickup would be for diabetes. And then as we have more conversations and there is more interactions with opinion leaders outside of India, we would build then the consensus on how the product should be used for obesity.
So you've described the size of the market. Can you put a dollar value on the market as well? How do you see it impacting Dr. Reddy's bottom line?
So if you see in terms of the Indian market, I think Satviki did mention that there are estimations. Some of them are suggesting in a few years' time that this would be $500 million, and there are estimates that it could be anywhere between $1 to $1.5 billion. So I would put this market in the next couple of years to shape around $1 billion in India. For Dr. Reddy's, we are taking this product not only in India, but we are in the process of the regulatory approvals across various markets. You did mention in the beginning of the session today that many markets like Canada, Brazil, Turkey, many markets in emerging markets are opening up as we speak. We're in the regulatory process, and we expect to be among the early generic companies to bring this product. And hence, for us, the generic semaglutide would be a meaningful product not only for India, but for the rest of the markets as well.
Yeah, let's talk about some of those overseas markets, and I do want to come back to the domestic Indian market as well. But I know that you have filed for approval in Canada. When do you think you'll be getting an answer?
So we have responded to the queries that we have received from the Canadian regulator, and we are waiting to hear back from them. We feel that we have responded adequately, and we should expect to hear back from them into the first quarter of next financial year.
And how about your filings in other countries like Brazil and Turkey, where the patent is also rolling off?
So in all of these markets, we've already filed the product, not just in Brazil and Turkey, in many markets. And what we've also done is, while we have a presence in about 45 emerging markets, we've also partnered with very strong generic, international generic companies and local companies in these markets, so that we're able to take this product to many of these markets where this product has not been adequately available. So that's going to play out over the next financial year, and as and when we get the regulatory approvals, we are in a place to provide the product to the country.
Well, of course, you're not alone. A lot of your competitors in India are working on and have developed similar semaglutide drugs as well. How do you compete, and how do you differentiate your product from your competitors?
So two ways. I think first is, whether we are fully integrated in terms of both the drug substance, the formulation, and then the ability to take the product into the market, so that you're able to first have a control on the cost, and second, you're able to realize a meaningful percentage of the value chain. Second, I think, is if you take this particular product, what we have realized is to build a sort of ecosystem around the product. First, we have been able to launch something called Sema Care, which is a digital app along with a counselor support that helps the patient come on board, and then through the journey with the interactions with the HCP. We've also been able to, with our joint venture with Nestle, come out with a set of nutritional supplements that is required for the patients and the consumers who would be taking this product. We have a product specifically in the form of Celuvida for diabetes. We have product that we're now launching for patients who take GLP-1, so that when it comes to the loss of muscle mass, we're able to provide the right sort of a nutrition to help the patient. So, and the third and the very important element is how we generate the local evidence in India on how the product should be used, how the product is being perceived by the HCPs, by the consumers, and have a lot of local trials in order to support the usage of this product and to build what we would call it as the obesity exemplar clinics around the world, around India. So we're building an ecosystem of expertise, of patient support and the right nutrition to support this journey, whether the patient is taking it for diabetes or for obesity.
Considering what you've just described, do you see that this could reduce the burden on India's public health system? And considering that, have you received any backing, even tacit, from the government?
So for sure, see what happens is when it comes to India has got both the payer market, which is supported by the government, and this particular product actually falls out of pocket, and hence ensuring that this product is available at the right price. And when it comes to Dr. Reddy's, we've always believe in one quality, one product. So the same product that we're taking to international markets, we have offered it to India. So I think in terms of today, the way in which the product is priced, there will be a good traction in the way in which this product would be consumed across the various Indian cities. So we would see going forward, obviously, the government is taking steps to support more innovative medications to come into to India. But right now, with the way in which the pharma companies have priced, this should see good traction from the private market.
Regulators in India, though, have banned advertising around obesity drugs like this to prevent aggressive sales tactics. How is this going to impact the way that you market your product?
So this particular product is a prescription product and hence has to be used only with the advice of the clinicians. And hence I think the regulator has done it right in terms of giving the guidance on how one should try to be mindful of trying to go directly to the consumers. And hence we are in fully support to that regulations, and we would be working with the clinicians to ensure the right dissemination of information and the usage of the product.
Well, as we mentioned at the start, this is being sold at a very low price, about $14 for a month's supply. Can you tell us about how that's squeezing margins? How profitable is this going to be?
So if you take India, there have been prices. The price that you're talking about is for a while. We have priced it pretty competitively, higher than that price. And there are companies which have priced higher than us. What we had done before we actually brought the product into the market, have done a consumer pricing testing, and we got to a sweet spot where a large number of clinicians and the patients felt that they would be able to take this medication should the clinicians prescribe the product. And hence, we priced a product over there. Now, when it comes to pricing globally, we expect that the pricing in Canada and the emerging markets would be higher than what we have in India. Hence, for a company that has got presence and has got plans to have this product in emerging markets as well as India, so it would be a sort of a balanced margins, a bigger portion coming outside of India versus what you would realize in India.
Are you researching any other products at the moment around diabetes or obesity, or in terms of Obeda, are you working on any different delivery systems besides just the pen?
So when it comes to this segment of peptides, this is an area where other than semaglutide, there are several other products that are either in the market or in development, and we're obviously looking at all of those products. Being a generic company, the idea is to bring in the product which is the current standard of care or the future standard of care, and hence we are working on a portfolio of assets in this segment. Coming to Obeda, there are work going on not only to have a better control on the supply chain and the cost, but also in terms of the delivery system as well.
All right, MV Ramana, Dr. Reddy's Laboratories, thanks so much for joining us today. Still to come, our exclusive interview with UBS Group CEO Sergio Ermotti, who warns of elevated energy prices for the foreseeable future. We'll have more on how the bank's clients are reacting to war risks next. This is Bloomberg.
If it lasted 3 or 4 weeks, maybe limited damage, but if it goes on any longer, I think, quite significant damage. The off-ramp is not a clear one.
I look around, in the China economy and the industrialists around. I think people do think that China also has many alternative energy sources.
We are one of the largest potato growers or partners to our local growers. So we are very confident that, we are very resilient when it comes to, upstream supply.
Every 10-cent change and only 10-cent change of the oil price will impact us all by about $500 million. And you can take the most educated guess probably of all of us, Stephen, on where the oil price will end up. This has serious ramifications for our industry.
Some of our guests at the China Development Forum in Beijing on how the conflict in Iran is impacting business. UBS Group CEO Sergio Ermotti says energy prices are likely to stay elevated, but clients haven't made major allocation shifts yet. Speaking to us exclusively at the China Development Forum in Beijing, he also shared his outlook for the Chinese economy.
This is basically the biggest topic we have been discussing lately. Of course, the good developments of China are somehow on the side for the second. But, when I go back to that, I do believe that China will continue to have a pretty good growth driven by innovation and the desire really to address also the topics of climate through innovations. And so, but in a sense, that kind of growth may be derailed by what's going on right now in Iran. Energy prices are likely to stay high for the foreseeable future, putting some inflation pressure and also some pressure on the delivery chain or on the supply chain. And in that sense, the situation is a little bit unstable.
We're into the fourth week of this war with no end in sight. Really, there's ultimatums out there. There are surely mitigation plans being put in place by businesses. What do you see as the direct cost to your business and your clients right now? And with no end in sight, how does that translate to mitigation advice?
But we saw clients already diversifying their portfolios early on this year. You saw much more dispersion in the way they were looking at maybe shifting away from more the AI technology to a more diversified portfolio. That was a good move considering what we see in the last few weeks. At this stage, clients are still, broadly speaking, calm. We don't see any major shift in asset allocation, but of course, this pressure that I mentioned before on the economy will start to weigh into the markets.
What are your clients directly telling you? I mean, they're worried about the length of this. Everyone I've talked to here, they don't know how long this uncertainty is going to last, and we don't know where oil prices are going to end up at the end of the day.
Well, the topic I would say is not only how long it's going to go, but really to fully understand how long it's going to take to digest the shock, somehow, the surprise of this crisis, particularly for the Middle East. I mean, the fact that the entire region has been destabilized in that way will take some time to be digested by investors and by the market. So I would say that I think it's much more important to understand the second part, the digestions, rather than how quickly this will end. I don't know how long it's going to go, but for sure, I don't think that we can have a situation like that going on for too long.
How cautious does it make you and your expansion plans? I know you just got the designation changed in the United States with the chartered bank there. That's a positive development. Last year, you got full ownership of the securities business here in China. I mean, does it affect your M&A outlook and how you plan to grow the business going forward?
Well, no. I mean, it's not. I mean, because we don't really run the business on a stop and go kind of. So I think that we may tactically have to slow down certain investments, but of course, the direction of growth in the US, in Asia, and across the globe is there. So I think that we need to continue to invest in capabilities, in artificial intelligence, to make our processes more efficient. We need to invest in order to make our client advisor more efficient in the way they serve clients. So this cannot change.
Any contingency plans you can reveal to us for your employees? You have a sizable presence in Dubai. You also have another presence in Abu Dhabi. What are you doing there?
No, we have been helping people to relocate with their families when it was necessary for personal reason or for security reason. At this stage, we are able to operate with contingency planning, both in the locations where we are based or with the support of outside colleagues that lives maybe in Europe or in this side of the world.
Can you update your position right now? Any change that you've seen from the Swiss government on the capital requirements? That deadline's coming up next month very quickly. I assume your position has not changed at all as far as the proposals for those big boosts in capital requirements by the Swiss government. Have you seen any conciliatory tone at all for any of the other suggestions?
No, there are no news. We do expect a formal decision by the Federal Council, our government, to be done by the end of April, or the early part of May. I don't know exactly the date. We don't know the date, but no major changes, and we are waiting to see the final outcome.
As it stands right now, unacceptable to you, right?
This is not going to work for us, and therefore, but we wait and see now. There is a democratic process. We contributed with our views on this process, and now we will see what is the final decision.
Now, in the last couple of months, we did see some news from you guys saying that you might stay on until 2027 next year as CEO. Then there's some reports as well that the board is thinking they want you to stay longer because of the uncertainty, because of these capital requirements. Is that something that is being discussed right now, that you would stay on beyond 2027?
Look, we always say that I'm going to stay at least until 2027, April 2027. Right now, we are very focused on finalizing the integration of Credit Suisse. It's almost done. It's not, and therefore, this is my focus, and then we will take it from there.
Before we go, get you an alert from New York. LaGuardia Airport is closed to incoming flights from across the US and Canada. This is after reports of a collision between an Air Canada Express plane and a ground vehicle. So that ground stop ordered at LaGuardia Airport expected to remain in place until 1:30 a.m. local time, although it's understood that that time period could be extended according to the advisory. Well, that is it for Insight. Stay with us. Horizons Middle East and Africa is up next. This is Bloomberg.